What's going on, everybody? Welcome back to your favorite YouTube channel. We've got an amazing video for you today. We're going to be looking at stocks that are down this year and also down within the last 10 years. But these stocks are special. They were selected out of the 9,000 or so stocks to be put into what is known as the S&P 500, the top 500 stocks in the US. So we are looking at a handful of special stocks that were selected to represent this ETF that have been underperforming for the last 10 years. The purpose of today's video is to find one or several companies that are number one, improving their margins, revenues, etc., but also building a large consolidation base over the last several years and looking ready to break out. These could be some of the hottest companies moving into next year. So looking at them now will set us up for potential success in the future. But in order to do that, we must hit the like and subscribe button, and we're going to go ahead and jump on in. All right, as promised, we're going to be going to performance year to date down. Right there. We're going to do performance over the last 10 years as down as well, 10-year down. And that'll be in the S&P 500. We also do want this company to be under 15 forward PE, meaning this company is technically undervalued, which is what we want. And last but not least, we want this company to be profitable. If we did not have this profitable filter here, we might be looking at companies that are getting further away from profitability, which is why they're probably in this predicament. But now we have 17 companies out of like 9,000 plus that are within the S&P 500 considered undervalued from a forward PE basis. They're profitable. The stock is down today, and the stock is down this year, but it's also down over the last 10 years. So the first three we will just take a quick glance at. It's going to be Bristol Myers, which is a healthcare company, ConAgra, a consumer defensive, and Campbell's, also a consumer defensive. And what we're going to do is just click the monthly chart on all of these companies. All right, and then we're going to move our way down to the income because we want to see their revenues growing. Total revenue on a quarterly basis looks good. Let's do annual. Yeah. So trailing 12 months, 47 million. So this looks good. We still have a couple months left for the year. ConAgra Brands Packaged Food, huge dividend here, 7%. That's kind of crazy. Revenues are 2023 was strong, 2024 decreased. What's their guidance for next year? EPS next year is 6%. Gross margin's pretty high. This one just really has not done anything in 20, 30, no, 20, 10, 20, 30 years almost, 30 years. The stock has kind of been flat. We're going to go ahead and just pass on that one. And we have Campbell's Soup. We're just going to go ahead and just see if their revenues are growing. They are. We'll keep Campbell's Soup on the docket. Gross margin 29%. That's great. Very over leveraged here. That does not look good. Big dividend. They are profitable. So we'll keep this one. Next, we have Edison, Eastman, and Fidelity. Ooh, Fidelity. Okay. We're just going to drop into the monthly charts. I guess the charts don't necessarily matter at this point because we're not diving in just yet. So looking at Fidelity, let's just make sure they are growing year over year, because that is importante. Yes, and yes, and yes. All right. EIX, Edison, big dividend here. Gross margins, nice. Let's look at revenues. Annual 16, 17. Yep, they're heading in the right direction. Eastman Chemical. All of these are in the S&P 500. You notice they're all big dividend players. And what they provide to the S&P 500 is stability. We just looked at ConAgra. Look at this company here. Oh, 20, almost 10 plus years, this company has been in the same place, basically. So these are very safe companies. Um, do we want to reduce our filters to remove dividends? Annual, it's growing. We're going to have to keep it. It's growing. We've got General Mills, Halliburton, CarMax. Let's see what we got. Again, over the last 10 plus years, just flat. Big dividend payer here. Undervalued. Kind of going down. General Mills kind of going down. Um, the one thing I want to know here, are institutions loading the boat on this one? And I only say that because if they are, they're taking advantage of this dip. They're kind of. It's kind of, you can see the wave effect. You know what? I think by looking at all these companies, we are accidentally building one of the strongest dividend stability portfolios. So if that's what this video turns into, we'll take it. Halliburton, oil, they're probably making billies. Let's see. 22 billies a year. Absolutely insane. Good dividend. I mean, the stock has done nothing for the past. If you've been in this stock since 2009, you are flat. You are flat. Um, they're at least 23, 22. They're going down. They're going down. We're going to remove Halliburton. CarMax, year-over-year miss. Okay. Oof. They're profitable. Gross margins 11%. Let's see their comes down to the sales, baby. I have not rented a car this whole year because it has been stupid insane at the airports. 28.2, 2023, 28.2, 2024, and it went down. Right now, they're crushing it. Trailing 12 months, they're crushing it, but they're spending more money to make it. So, I mean, gross profits are growing. Gross profits are growing. I just don't see CarMax being a growth company. It's more of like a stability play. We're going to remove it just because it just it doesn't. It used to be $1, got as high as 140. I mean, it could eventually turn around. I guess we'll keep it because you know what? Once it does turn around and stabilize, it is undervalued. Yeah, it is severely undervalued. Gosh, these are just decent companies. They're growing too, which is hard. I would say we would cut this one off. We would cut that one off. General Mills, their year over year, they were going down. 19.8, 19.4, 19.1. We'll cut General Mills off. Fidelity, they were growing. Yeah, they're good. Eastman Chemical, they're gonna make it. Edison, they're making it. Campbell's Soup, how are they doing again? They're gonna make it. Yeah, they're doing good. Bristol Myers, 45, 48. Yeah, they're on track to do big things. Okay. Southwest Airlines, OIB, Norwegian Cruise Lines. All right. I did not anticipate all of this at all. Airline company, just, I don't know, 26, 27. They're gonna make it. Is their chart consolidating on a monthly basis? Let's see. Cheers. Don't get water. Wow, if you've owned the stock since 2014, you're upset. Wow. Actually, if you, yeah. Holy cow. Yeah, I mean, it's growing. We're going to keep it. So the point we're getting to is determining if we're going to keep these companies or not. Huge dividends here. They're profitable. Is this tobacco? Specialty chemicals? Why is this so gross margins? EPS is ugly. Let's go down to the revenues. Let's look at the revenues. 2023, 40.9, 24, 40.2. Ooh, are they going to make it? When's their next earnings call? They just had it. This one we're going to have to eliminate. Goodbye. All right, Norwegian Cruise Lines. Still recovering from COVID. They're profitable. Let's look at the sales. Yep, they're profitable. They're good. No dividend here, so that's something to note. They're basically back at their almost IPO price, 2013. All right, and then we're gonna look at PG&E, Schoenberg, Stanley, and we'll just get TAP and UPS. All right, PG&E. This one's solid. This one's just, they're crazy. 24 billion in sales, undervalued in the future, 18% gross margins. 24,428, 24,419, 24,453. This is just a safe company. If you've owned this, oh my gosh. Going all the way back to 1984, it's flat. But you've collected a dividend, but it's flat. Jumping into SLB. Again, we're not going to look at the chart yet. We're just going to go down and look at the revenue. 33, 36. SLB looks like it is on track to exceed, so we'll go ahead and keep it. Stanley, Black & Decker. Again, chart doesn't really matter here. Let's just go down to the revenues. 15.7, 15.3, 15.1. The trend does like it's going down. However, gross profit is increasing. So we will keep this one. Molson Coors, alcohol beverage company, 11.7, 11.6, 11.2. Not super optimistic about alcohol beverage companies. I think there is a permanent decline in people who drink alcohol. So we're going to remove that. And we're looking at the UP to the S. And this one has been deadly on the downside. 90.7 mil, 90.8 mil. Gross profit is falling as well. We're going to remove a UPS. Perfect. We've made it through all of these companies. Now what we need to do is look at the monthly charts and see from a high level perspective if they have a potential of turning around. We specifically want to look for companies that are building a base. So we're going to begin with Southwest Airlines. I do believe that this one is repeating a historical pattern. So if we look here, we see a nice arc, consolidation move. We have a nice arc, consolidation here, potential move. So this one is going to be put to the side for further review with the stock price calculation, insider review, and technical analysis. Norwegian Cruise Line, again, we got a 5-year support here from about 10 to 30. It's just been going sideways. They are profitable, they are growing. This is one we're going to put to the side. Schlumberger, oil and gas. The chart does look like a head and shoulders. We had a left shoulder, head, right shoulder here. And our neckline to break is, or our neckline to touch. It is there. So we're going to go ahead and put this one on our stocks to review later. Stanley Black and Decker. Let's see how this one looks. I mean, historically, it doesn't look too bad. It's trading at the same levels as 2013. 2013 around $78. Sorry, December 2012, $78, went all the way to 222 and crashed. We have our bear flag here. Here's our flagpole, flag, fall down. Now it's in an ascending triangle, another move down. We'll remove Stanley Black & Decker. It'll probably be a good company 5-10 years from now, but not anytime soon. Bristol Moyes. This company has been consolidating in this $38 to $77 range for over 10 years. I do want to review this one. Campbell's Soup. Now this one looks interesting because they're growing pretty nicely and their gross profits are decent. Billions. It's in the billions. And the chart looks pretty ugly. I mean, you had this period of just euphoria. Stock was around $3, went all the way to 59, came down. And it's just been kind of basically sideways ever since. It hasn't really found a bottom yet. So this one would be really fun to chart and just have in our back pocket. Because it is a nice dividend paying stock. It's growing. So we'll put it on the back burner. Edison, again, they're looking very nice as well. Gross profits growing nicely. The chart, the monthly chart, it is hovering around the 200 SMA. This is the only time the stock has really ever been under the 200 SMA in the last 25 years, which is crazy. So this is one to watch. We're probably going to see a nice move down here. So yeah, it's very undervalued, very nice dividend paying stock. Again, we're going to put that one on the books. Eastman Chemicals outlook to negative. Okay. This one has a huge 10-year consolidation range. It's undervalued significantly. It's got a nice dividend. Look at all these buys. They're growing profit. Profit's growing nicely. I mean, this one, again, this is going to be another one we're going to drill into. And Fidelity. Now this is going to make a large move down, in my opinion, probably down to 40s. We're going to see a death cross where the 200 is the 50 is going to cross the 200 on the downside here. So Fidelity is going to be a very attractive stock here, probably in the next 7 months. So we're going to want to chart that one out. So we've got 2, 4, 6, 8 stocks to dive in deep. These are going to be their own videos. I am going to prioritize them later. So they're going to be coming out probably December, end of the year, just because these are more defensive type companies. These ones are the stocks you have in your portfolio to kind of keep everything level and also give you income. So these ones are going to come down the road, but in terms of companies within the S&P 500 that have not been doing that well, however, could be turning around here potentially, we want to find where their apex is, where resistance meets support, watch for that key turnaround, add it to our portfolio, and sit back and relax. So if you made it this far, I appreciate you more than you know, and I'll see you in the next one.